IVM.
The CRED store has me hooked. Specially curated products from over 250 brands and the use of CRED coins to avail exclusive offers and deals across categories like food and beverages, electronics or home decor, etc. That means if you're buying electronics or home decor, it's a discount city. So don't miss out. Download the CRED app now. Folks, welcome to Paisa Vaisa presented by CRED, the most rewarding credit card bill payments app and powered by Quartr. I'm your host Anupam Gupta, BB3 on Twitter. I'm really thrilled to have with us one of India's leading independent multi-family office and wealth advisory firms, Waterfield Advisors. As per their website, they advise on over $3.6 billion of assets on behalf of several prominent Indian business families. My guest, Rohan Paranjpey, head Alternative Investments, Waterfield Advisors. We're going to talk about a very interesting product. Honestly, when I heard of a wealth advisor launching a fund of fund, I thought, hey, that's very interesting. So this next episode, this episode, we're going to talk about a lot of stuff from, say, a VC's point of view, a founder's point of view, a wealth manager's point of view, a lot of very interesting angles coming up in this very unique episode. But before that, let's take a short CRED convenience break and we'll be right back on the other side. Security on a computer is like a layered cake. No matter how secure each layer may be, attackers and hackers will work tirelessly to find a vulnerability and exploit it. These cyber attacks can sneak into a system unnoticed, eventually gaining access to all the programs and files on a computer stack. Luckily, with the Intel vPro platform, all of this is avoidable. Intel vPro has the Intel hardware shield, which adds protection to every layer of the computer system with 3 groups of security capabilities. Advanced threat protection, which helps quickly detect and remediate the latest ransomware and crypto mining attacks on the system. Below the OS security, which helps identify unauthorized changes to hardware and firmware. And application and data protection, which helps prevent memory corruption and malware injection. So, secure your organization's productivity with hardware-based security only with Intel vPro. Visit www.intel.in/IT heroes to know more. Intel vPro, built for business. Rohan, welcome to Paisa Vaisa. Thank you so much for doing this for our listeners. A very quick, very brief introduction to yourself. I know that you've got a really rich background on the VC side and to Waterfield for our listeners.
Sure, Anupam. Great being here. Thank you so much for having me on the program. Quick background let me start with Waterfield. So Waterfield is a wealth advisory firm that was started by Soumya Rajan in 2011. We're in our 10th year right now. Soumya used to be a very senior person in Stanchart in the wealth practice and essentially saw that there was a lot of, let's call it ambiguity in terms of the type of service and type of advice that was given out by wealth firms in India, especially because of the distribution model, where the firms giving the advice are getting paid by the products that they recommend. And so Waterfield was started almost as an anti-hero, if you will, or almost to flout essentially this concept and provide a completely transparent, clear, zero conflict of interest advisory for UHNIs and HNIs and family offices in the country. And we've been on that program since we started almost 10 years ago. And what that means essentially is that we don't get paid by anybody else. We only get paid by our clients. So we have no incentive to recommend anything that we don't firmly believe in. That's a bit about Waterfield. I think very quickly we've grown into a very large firm in the space. Like you said, $3.6 billion under advisory. And primarily that's because we work with some of the largest families in the country. As you can imagine, more and more of these family offices started looking at venture capital, private equity investments very keenly a few years ago. And that's when I joined them to set up the alternative investments advisory practice. My quick background, I come from the venture world. So I spent a few years in an early stage technology startup, after which I worked with Bloom Ventures, which is one of the leading early stage venture capital funds in the country, primarily looking at fintech investments, had my own little portfolio. But I also started noticing some very clear gaps in the market, and that's kind of what drew me to Waterfield. and eventually has led to the launch of the fund, of course, which I'll be more than happy to talk about.
Let's jump into it, Rohan. When someone says fund of funds, the first thing that that comes to my mind is mutual funds. We don't get wealth management firms that run fund of funds. So can you please explain, to our listeners, what exactly does your fund of fund does? I know that when it comes to a mutual fund, a fund of fund is someone that invests in other funds, feeder funds, international funds, stuff like that.
Yeah,
so just probably a quick factual backgrounder to help our listeners understand your product.
absolutely. I think conceptually speaking, you've hit the nail on the head. So a fund of funds is nothing but a fund that invests in other funds. Our specific fund of funds, what it does, it is that it invests in venture capital and private equity funds and co-invests with those funds directly into companies. To dial it back a bit more, just to give your listeners a very high-level background, a venture capital fund is nothing but a fund that collects capital across domestic and international institutions and family offices, pulls it into a fund vehicle and invests that capital into startups. And a private equity fund is something similar, but not quite. It raises capital from similar sources, but they end up investing in slightly more mature companies, but those companies are not yet listed. Our fund of funds picks such venture capital and private equity funds in the country and invests in those funds. The technical term for an investor in any of these VC and PE funds is a limited partner or an LP. So we are an LP in venture capital and private equity funds in the country. And we also co-invest directly into the companies that these funds have invested into.
So that's really interesting. I'm trying to understand this now from, I guess, a venture capital point of view, Rohan. So most venture capital firms, as we know, are international firms. You have probably the best and largest VC firms globally. All have a very large stake in the biggest of startups here in India. Okay.
Yeah.
But we don't have Indian venture capital firms, or even if they're there, I don't know. Help me out. Why and how does this situation affect the Indian family office? Because I'm guessing your clients are typically either ultra HNIs, family offices, that want to invest in domestic startups. So just help me build this picture.
Absolutely. And you're absolutely right, Anupam. So let's look at the history of venture capital, right? And I won't go too much into the details, of course, but essentially venture capital, because it invests in very young companies, startups, as we know, it usually takes a long time for these startups to mature and then provide some sort of an exit to these funds. And so each venture capital fund is a 10-year long fund. Now, this as an asset class in India is very, very new. However, it's been around in, let's say, the US for many decades, starting from the 70s and 80s. Apple, Google are all venture capital funded companies. And, Sequoia, for example, was one of the first or one of the best known venture capital funds that emerged out of the US and out of Silicon Valley. So it's a long gestation asset class, if you will. And it takes a while for a few cycles to get completed. And geographies or countries which have seen this cycle play out know that it can be very, very lucrative. However, in India, if you really think about, let's take Flipkart, for example, which is probably the most well-known venture-funded company that we had till recent times. Started around 2002, 2007, 2008, finally gave an exit to its investors in 2018, 10 full years. So as you can imagine, this asset class is very, very new in India. In fact, it was almost unheard of in India till late 2000s, early 2010s. And now, again, it's a bit obvious maybe that the countries or geographies or funds which have operated successfully in other parts of the world saw the potential of India as a market, and they decided to set up shop here. So Sequoia, as you know it today, started maybe 13, 14 years ago or around that ballpark in India with a team that was put together. But the money for Sequoia India to invest came from the same investors that invest in Sequoia US, right? So they had their own set of LPs, if you call, as you know them. And LPs for Sequoia are some of the largest pensions and endowments and institutions, global institutions. So a lot of that international capital was invested in India as part of the beginning of venture capital. Same thing if you look at Axel. Axel also, the team here, in fact, was operating just before they were bought out by Axel Partners, if I remember correctly. And Axel Partners, again, raised money from the same people that Axel US raised from. So a lot of international capital was funneled into this India ecosystem through these conduits of local teams, but global brands. And that's because those guys knew the potential of the market. India only started seeing some homegrown funds in venture capital around 2010, 11, 12, when my former employer Bloom, along with India Quotient K Capital and some of the other guys started and started raising a fund. And that was probably the first time when they even asked, family offices about investing in such a product or such a platform. Till then, this asset class was unheard of. As you can imagine, because it takes so long for this asset class to give out returns, even those 2010, 11, 12 funds are still within their fund cycle. But the market in India has evolved dramatically. Unfortunately, what that means for our family offices is that they never got access to invest in some of the largest funds which operate in the country so far, which are your Sequoia, your Axel, your Nexus, and Matrix, all of which raise only international capital. The good news is that slowly but surely, you're seeing more and more fund managers emerge in India who are willing to raise capital from Indian investors as well. I think there's a lot of factors that have played into it. I think one big factor is that regulation evolved very rapidly to accommodate such fund managers, if you will. The AIF regulations are very transparent, very open. So, people prefer the fact that there is no ambiguity at all from a regulatory perspective to set up shop here. And then there were some carrots that were dangled to set up Indian vehicles as well. So a lot of that story is playing out now. But I think the most important reason for this happening is that now that India has seen almost an entire cycle of venture capital and has seen some exits, there is there's a lot of confidence about this asset class in India. I think that's why I think even fund managers are willing to open their doors and accept domestic capital, because they know that the investor today is a lot more sophisticated than they used to be, 5-10 years ago.
Yeah. Okay. So we've covered the VC side, Rohan. Let's talk about this from the family office side or from your client side. Let's just say that what are my options? I'm an ultra HNI, or I'm a family office, and I want to invest into the Indian startup story. I'm seeing all these headlines every day. Unicorns are forming, and this is happening, and that's happening, and it makes a lot of sense for me because I'm someone who wants to take that risk, savvy enough, long-term holder. And what are my options here? Top of mind, what I can think of, I would go for an AIF, an alternate investment fund, or probably I don't know whether a platform makes sense. We've had a few platforms on our show. And third is I would just reach out to founders directly, maybe through my friends and family circle or whatever.
Right.
Why would I invest in a fund of funds? Just,
Right.
Help me to just stack this up from that angle.
Absolutely. The thing about this asset class is that it's a very small set of people. Let's take venture capital, for example. Of course, there are more and more funds emerging every day, but there are very few funds which have been investing in India, in the country, for the past 5, 7, 10 years. And each of these funds is usually very small in terms of the number of senior people that they have. Everybody knows everybody. It's quite a small community. And what that has created is this sense that the best founders or the best companies end up going to those most well-known or the longest or funds which have been around for the longest, because there is that certain level of comfort that, what I'm doing, only these guys can understand. Unlike, the public markets where anybody can wake up and buy a stock on the using any sort of brokerage platform, that's not the case here, right? Here, people are invited to participate, or you seek people's money to invest in your company. What that means for a family office. Now, let's say you were to invest directly in startups, right? The good founders, like I said, prefer to go to the tried and tested VC firms because they know that these VCs have seen the cycle. They know exactly what the challenges are that founders face. They might be able to help me build my company out to a level where it's huge, right? It can scale faster. So those founders prefer to raise money only from institutions. Very rarely will they decide to raise capital from individuals who they don't know. A lot of times, like you said, if a friend of yours calls you up and says, listen, Anupam, I really like you. I'm starting a company. I want you to be a part of that success story. That's fantastic. But how often does that happen, right? How often do your friends start companies? And how often are these guys very, very capable of scaling a company to tremendous heights? You don't know. It's a hit and miss game, and it's very low probability. So you rely a lot on the people you know, and you rely a lot on your past experience. So if the best founders end up going to the best funds, what happens to the rest, right? The rest of the founders, the rest of the companies which are in the market, just started, maybe they don't have a strong enough network, or maybe they've heard no's from all the VC funds. That's when they start looking at other sources of capital. That's when they start saying, hey, you know what, maybe I can go to an angel network and try my luck there. Or maybe I can just call up a few family offices that I might know or that my friends know, and maybe they'll start investing. So there is a very strong adverse selection issue in this asset class when it comes to investing directly into companies. So that's been the challenge that family offices have faced when they started looking here seriously, maybe 5-6 years ago. You saw a big flood onto angel groups, onto angel networks. There were some platforms which also emerged out of it, which tried to professionalize or institutionalize angel investing to a certain extent. Maybe they met with some amount of success or not, but largely the highest quality companies stayed out of those networks. They never reached those networks, and you never got that opportunity to invest. The other source, or rather the other opportunity that family offices got to invest directly into companies was when these companies had scaled up to a large extent and wanted to give their employees who were ESOP holders some liquidity, right? So let's say the first 20, 30, 40 employees who joined the company, they all got ESOPs, and if the company scaled beyond $1 billion in valuation, $2 billion in valuation, so ESOPs are worth a lot of money. That's when a lot of these companies essentially started working with wealth distributors in the country and said, if I go to my existing VC fund investor, they will want to buy these shares at a discount. But hey, maybe your family offices won't be that picky about price. So can we give my employees some liquidity by raising capital from family offices and let them buy out their shares? So you saw two ends of the spectrum. If you were a family office investing in this asset class, you either saw very young companies who had mostly heard no's from established VCs, or you saw very large companies at inflated valuations just because they were giving out liquidity to their employees. That's one form of investing directly into this asset class. Then the other option that was left for you was investing into venture capital funds. Now, interestingly and unfortunately, VC funds also behave in a similar way to founders, where they prefer to raise capital from institutions. And this is a very interesting point that I'll maybe spend a couple of minutes on.
Sure.
Because I've been in a fund and I've seen the struggles that fund managers face when raising capital. Usually when a fund manager starts off, let's say in India, I think the first fund is on the back of friends and family, especially if you have no experience of investing. The first fund is always friends and family, right? People you know, people who you trust, and people who trust you, give you some money, let's get going, let's start investing, let's build a track record. Correct. The moment the track record starts getting built, most fund managers prefer to raise international capital wherever possible as opposed to Indian capital. And that's for a few reasons. International investors, like I said, because they've seen this asset class evolve in multiple geographies, they know that it takes time. And so when they make a commitment to a fund, not only are they willing to invest larger amounts of capital, they also invest across multiple fund cycles. So they won't just say, I want to invest $2 million in your fund too. They'll basically say that I'm going to start with 5 million in fund two and keep increasing my commitment in fund three, fund four, fund five, if you perform well. So from a fund manager's perspective, the holy grail is if they never have to go out into the market to raise additional funds, if their existing investors are so happy, then they keep giving them capital. Domestic family offices, unfortunately, is the exact opposite story. They've not seen this asset class evolve much. Now, of course, we're in a different, let's call it a post-Zomato era, if you will, right? Where at least people have seen that it can work. But till very recently, investors in this asset class had not necessarily seen a whole cycle. They'd not seen great return. A lot of domestic family offices don't have deep check writing capability. They don't invest 15, 20 crores in a single fund. They can't, right? They usually invest 2 crores, maybe 3 crores. And that's only because the minimum per SEBI to invest in any of these funds is 1 crore. So they'll invest small amounts of capital. They'll invest it a lot more opportunistically. Hey, I have some liquidity. I've heard good things about this asset class. Let me just put a token check in there and see what happens. They're not necessarily looking at this as a 20-year relationship. They're not saying, okay, I'm going to invest 2 crores in this fund now, invest 4 crores 3 years later in their next fund, and 10 crores in the fund after that. They're not thinking about that. And so for a fund manager, it's almost like saying, wow, I have to service these investors, which are the domestic family offices, the same way that I have to service an international family office, except that they're smaller checks, they're not reliable, they may not come in the next fund. And so I might have to do this whole process all over again in my next fund. So what you've got suddenly is a situation where maybe some fund managers have learned, or like the family offices in India have paid the tuition fees for some managers to become good at what they're doing, but then they're missing out on all the future returns that those funds can generate because fund managers prefer international investors. And so suddenly you've got a whole host of fund managers who have started up recently in India, don't have too much of a track record. So it's difficult for them to attract international capital. They are now going out and raising a lot of domestic capital as well. So you've got an adverse selection issue on both sides, on companies as well as funds, which is very unfortunate for domestic investors who are trying to start off in this asset class and don't want to commit, the kitchen sink to something that they've never done before.
Yeah, it's an interesting situation. I think it's evolved. It's taken its time to evolve. Okay, last couple of questions on this side of the episode, Rohan. So first is a very general question. What you speak to these family offices. What's the general mood out there? Are they as excited as the public fund managers that we have? Who are quite vocal. You see them on social media. You see them on television, and they're all talking about India's prospects in this next coming decade. What's the feedback that you're getting? Any interesting trends that you can tell our listeners?
I think what's interesting for me is over these past 7 to 8 years that I've been in this asset class and maybe a few years outside of it, to tell you kind of a funny story, when I graduated from college in that 2007-8 time frame, whenever my classmates decided to start up at that time, the joke was that they couldn't get a job in placements. And so they started something of their own. And then you cut to, 4 or 5 years later during business school, for me at least, when I'm sure a lot of people saw it, a lot of startups, quote unquote, were coming to recruit on campus, right? And suddenly getting a job at Flipkart was not seen as a cop out or a sellout or a mark of not being worthy. If anything, the best of the people on campuses were joining these companies, Flipkart, Snapdeal, you name it. And then suddenly the evolution was that people who said that I started up on my own, I've been working, I was working on my company for the past 3-4 years, but it didn't work out. And I want to join a corporate Now, suddenly that experience is not discounted. If anything, corporates are willing to put a premium on the kind of experience that somebody who's worked in a startup or started his own company brings. And this has been on the job side or the corporate side. I think while family offices maybe were a bit slower in accepting this asset class, maybe they weren't as excited about it, in 2012, 13, 14. I see a remarkable sea change in terms of their acceptance of this asset class. Now, I think everybody recognizes that there is a lot of potential here. Everybody loves the fact that they're all customers for a lot of these products, a lot of the startups which are coming up. Zomato is a great example. People were using Zomato, they just didn't know how to get involved with Zomato, right? And so when Zomato lists, people are very excited. And so they're seeing this opportunity as very exciting, as something that has a lot of potential. But I think what's most interesting for me is that the generational divide is showing now within family offices. The younger generation understands this asset class or believes in this asset class a lot more than the older. The older generation will still ask, hey, how can a loss-making company be a good opportunity to invest in? And the younger guys are saying, I use this product, I use this company. I know that this is a great business because I can see many people like me who want to use the same product. And so family offices, at least over the past 3 years that I've been working with them, they've seen a dramatic, I've seen a dramatic change in terms of their acceptance of the asset class, their interest. And I think it's showing in terms of their allocations to this asset class as well, where, they started off with 2, 3, 4% of their overall portfolio. Now, a lot of them are very comfortable going up to 10%. And
wow.
We've seen people doing up to 20, 25% in startups and funds.
Sure. Okay. Last question before we go into the break, Rohan. What are your strengths? Typical wealth advisor advises on a whole lot of assets. Startup is not among the top 3 out there. But typically, so in your case, what are Waterfield's strengths in identifying the right funds to tap into the Indian startup story?
Yeah. No, I think this is a very important question, Anupam. I think more because, because this is a relatively new asset class for everybody. What has happened is that it's grown very organically. You have your path breakers who decided to even set up a VC fund and start investing in companies when nobody had heard of venture investing. And you had your very progressive family offices who decided, hey, you know what, I'm going to give it a shot. I'm going to start investing in this fellow. However, there was never any sort of institutional way of evaluating funds because there was never any track record, so to speak. Funds had just started. I think where Waterfield is very different compared to any other wealth firm is that we've really doubled down on our ability to evaluate funds, which is a very different strength compared to investing in companies, right? So it's not the same at all. And the way we've done it, I think, like I said, we were always a zero conflict of interest advisory platform, which means when we advised our family offices to invest into funds, we never got paid by the funds. We only got paid by our clients. And that essentially meant that we didn't have a commercial arrangement with any fund in the country, which means we were able to work with every single fund in the country. Because most funds saw us as a great way to raise easy money, if you will, right? It's free money. But what we did was we used a lot of the data that we got on working with all the other funds and doubled down on building analytics capabilities and a repository of data that nobody else in the country has, and making decisions which are not just qualitative, but also quantitative. And that really helped. And that, of course, meant that we were very, very picky in the kind of funds we picked. And the fund of funds was a natural extension. I think that's one side of the story, right? Where you kind of put your data and your math and your sort of intellect to work because of the business model that helped. The other aspect, which is the softer aspect, which is still very, very prevalent in this space, is that of relationships. I think about it, if you were one of the best fund managers in the country and you get to pick and choose the kind of investors who come into your fund, you want investors who you trust, who you like, and who you think will add value, right? You don't want people who are just coming in with money and then sort of calling you every 2 or 3 years saying, "Hey, what happened? Where's my return?" Right? Or worse yet, people who invest the money and then just forget about it entirely. And that's the situation that we have in the country today. The best fund managers are very picky about the kind of investors they bring on. I think Waterfield as a firm, because it's been doing this for a while, plus the fact that our team is primarily composed of individuals such as myself who've actually been in a fund, understand what it takes to run a fund, or have been in a fund of funds, a global fund of funds, and understand, how global investors in funds look at fund investing. I think that has drawn a lot of these fund managers to us saying, listen, if I have to have an LP, I want Waterfield on my side. If I have to have a domestic LP, I'm very happy to work with Waterfield because I know those guys and I think they can help me out.
Very interesting. So, folks, on that note, on the strengths of Waterfield in identifying the right funds, let's just take a CRED convenience break. My guest, Rohan Paranjpey, head alternative investments at Waterfield Advisors. On the other side, we're going to look at the actual product, how it works and how it benefits both sides of the table. Right? We'll be right back.
$100. That's all it takes to begin your journey with Bitcoin and Ethereum. No, really. With CoinSwitch, you can start investing in over 100 cryptocurrencies with just 100 rupees. On top of that, there are zero charges for deposits and withdrawals, so you can trade, buy, sell, however and whenever you want. All of this, plus their extremely intuitive interface, makes CoinSwitch the perfect app for beginners in the crypto space. But don't take my word for it. Just download CoinSwitch for free and try it out for yourself. If you'd like more information on cryptocurrencies, tune into a show about crypto with me, Rohan Joshi, my new adventure on IVM podcasts. CoinSwitch, kuch to badlega.
And now, folks, we have a listener's question on company analysis.
Hello, Anupam. Where can I get earning reports, stuff like the result table, investor presentation, etc. for companies I track?
Well, I'll tell you what. Check out the Quartr app. Okay, the app has a press release from the company. The press release that the company declares each and every quarter, which contains the earnings table and the investor presentation and basically everything that the company declares with its quarterly results, which is mandatory by the exchanges. And you can check all of this data. It's in easy downloadable form on the Quartr app, right? So let's say that you're tracking a TCS or a Reliance and you want the latest earnings report. The company declared its earnings yesterday and you want to check out the table and anything else. Well, the Quartr app has all this. It has everything that the company releases and declares to the exchange each and every quarter. And the app is called Quartr. So that's a Quartr app. QUARTR, right? That's a Quartr app.
And welcome back to this episode on Paisa Vaisa, the Waterfield Advisors special. My guest, Rohan Paranjpey, head alternative investments at Waterfield Advisors. Okay, once now let's jump into the product. Okay, so when I look at this from both sides of the table, when let's say that I'm an ultra HNI or I'm a family office and I'm putting your money into your fund of funds, what do I get in terms of exposure to startups, to portfolios, to sectors, etc.? The next question, we look at it from the founder's perspective. Okay, let's start this from the first side of the table, the investor's side.
Absolutely. So let me give you a very high level of how the fund of funds is structured and maybe spend a few minutes on the different types of investors that we've seen in our fund. Right. So the fund of funds, broadly speaking, the way it's structured is that for every 100 rupees that we raise, a portion goes to take LP or limited partner positions by investing into venture capital and private equity funds. And then a portion of the capital is co-invested along with those same funds directly into their best companies. And that's kind of how the fund of funds is structured. Now, to be able to do all of it, there is, of course, a certain fee that's associated with it. There's a fee that enables us to find the right fund managers to partner with. And the fee also kind of pays for, if you will, our abilities of picking the right companies from those fund portfolios to co-invest with. underlying funds, when we invest in them, they of course have their own fees for the same reasons that we charge, right? They need to set their shop up, hire people, look at companies, multiple companies, end up investing and then working closely with those companies all the way to exit. So that's broadly, in a very simplistic way, that's how the fund of funds is structured. Now let's look at the kind of investors or LPs we ourselves have had in our fund of funds. So you've got one type of UHNR family office who has, been looking at this asset class from a distance, have never invested in any fund, don't expect to invest large amounts of capital just yet, but they know that there's money to be made. They know that something interesting is happening. I've been completely dissociated from this world. How can I get involved? And a lot of them look at the fund of funds as a great way of getting acquainted with the asset class. And the reason why they do that is because they know that through our fund of funds, they'll end up getting exposure to the best VC and PE fund in the country and exposure to their portfolio companies directly, which they otherwise, by not having been frequent investors in this asset class or investors at all in this asset class, by themselves may not be able to get, right? So they're looking at this fund of funds as a great way to start investing in this space. At the same time, they also look at the fund of funds as a great way to manage risk. And I'll get to the risk portion in just a little bit. That's one type of family office. What the other thing that we've decided to do with the fund of funds is that we want to take positions in funds across various stages and strategies. So for example, if we're investing in 5 funds, we expect two of them to be venture capital, 3 of them to be private equity, and each of them to be investing at a different stage in a company's life as per their strategy. So we won't have 5 funds which do only seed investing, which for example is the riskiest part of investing in this asset class. And we won't have 5 funds who do only pre-IPO investing, for example, which is probably the least risky, but maybe the returns are not as high as you would expect. So we end up taking exposure across various strategies and various stages. I think that as a bouquet or as a single platform appeals very greatly to these family offices, because if you go up to somebody who's never invested in this asset class and say, hey, do you like that seed fund or this seed fund? They're not really going to have an answer because they don't even know what seed investing is. And you go to them saying, do you prefer a mid-market private equity to a buyout strategy? Again, no answer, right? So we've tried to simplify the whole thing for them, saying, you don't worry about what parts of the curve make most sense. What we are doing is giving you exposure across the entire curve. And better yet, we're giving you exposure in the best funds at every stage of that curve. And we also get to co-invest with them. So that as a package works well for these guys. Then you've got another type of investor who has been investing in this asset class for a while, but maybe has not had a great experience in terms of fund investing. Maybe they happened to choose funds which did not end up performing too well, for example. Or maybe they realize that, my passion lies in direct investing. I prefer directly investing into companies. I don't like fund investing. Now, the interesting thing about that is that because of what we highlighted earlier, direct investing is not easy. You don't get access to the best companies for direct investing unless or until you frequently invest large amounts of capital. The other way to get access to those companies is through a co-invest. And so for a lot of these families who prefer direct investing, they see the fund of funds as a great way to essentially build an LP position with the least amount of hassle. They don't have to go to 5 different funds, invest in each and every one of them, and invest large amounts of capital to get co-invest access. They just look at the fund of funds as a great and simple platform where they can invest a certain amount, which will give them disproportionate co-invest access by virtue of the fund of funds itself being a large investor in these funds. The second thing that they realize, and here I'll touch upon the risk aspect. Sure. Fund investing, venture capital and private equity funds intuitively seem like diversified instruments. Hey, they invest in multiple companies, so the risk is automatically lower of investing in a fund versus investing directly into a company. However, what people don't realize, and what fund managers will happily tell you on venture, is that the returns of a venture capital fund are usually driven by one or two big companies. Now, what happens if you've got a fund which is in its 7th, 8th, 9th year, about to close out, about to exit, holding on to the best performing two companies in its portfolio, and something like COVID happens? And COVID happens in a way that it affects those two companies worse than it affects some of the other funds and their portfolios. God forbid that happened, but unfortunately, a lot of fund managers did see that with COVID. And so what you're essentially seeing is that while the fund is a diversified instrument, if something happens to their best company, your returns look terrible. So that's where a fund of funds comes in. Because if we've taken positions in 5 funds, then our returns are dependent on 10 companies and not just 2 companies. So what are the chances that something bad happens to 10 companies, all 10 companies in their portfolio? Much lower than for 2 companies to get impacted. And so the risk of investing in a fund of funds is a lot lower than directly investing into any fund. So which is why that segment, which has done a lot of investing in this asset class, still prefers the fund of funds route, because they understand that, at least this way I'm protected. My LP position is protected a lot better than if I invested all of that capital in a single fund.
Okay, let's flip sides now. Founder. I mean, if I'm a founder of a startup and I'm getting a fund of funds, your fund of fund on board with me, what are my advantages? What am I looking at out here?
So, this is an interesting point. I think basically a founder will never by themselves try to raise from a fund of funds platform, right? That's not their port of call. Their port of call is going to be VC and PE funds, right? Funds which invest directly into companies for a living and with their entire corpus. Now, what happens is, let's take, some of the best companies in the country which have scaled very rapidly. Very few people got access to invest in those companies. It was almost only always institutional investors like VC and PE funds, which means that if you're not somebody who can cut 20, 30, 50, $100 million checks, how do you end up investing in a company that is growing really, really fast? Well, the answer is that the early or large investors in those companies have some sort of a relationship or pull with those founders to say, hey, you know what? In the next round, please give my LP a position in the company. All right, or please allow my LP to invest alongside me in your company. And, I've been with you for a while and I own a large percentage of your company. This is some small favor that you have to do for me, right? And so from a founder's perspective, to a certain extent, there is a sense of obligation. Your hands are tied to a certain extent. So you say, okay, fine. You know what? You've been a great investor to me. You've been on my board. You've been very helpful. I will let some of your investors come in, but I don't want 25 people on my cap table. I don't want, I'm a $400 million company. I cannot have people investing 1, 2, 3 crore checks. That's just not going to work for me. I cannot manage that many number of investors. And that's where a fund of funds is actually quite appealing, because because we're LPs in some of these large VCs, and if those VCs say, no, one of my LPs, which is the Waterfield Fund of Funds, is going to co-invest with me, and it'll be a largest check. It may not be huge. It's not going to be hundreds of crores, but it'll be a largest check. And they're an institution. A lot of the founders are very happy. They say, okay, great. If they're an institution, which means I know that there's not going to be too many issues. In India, you still have to get signatures from every single shareholder for every little thing that you do, even in a startup, which is a very painful exercise. So they know that if it's an institution, it'll be clockwork. When we send a request, the papers will be signed, documents will be sent. Great. Plus, my VC investor who has vouched for these guys will also ensure that they get complete information on what's happening in the company. And they will also, to a certain extent, dictate the exit of that investor. So I'd much rather have an institution on my cap table than a collection of 25 individuals who are putting in small checks. So even, which is the irony of the matter. Let's say you invest as a family office, you're a 50 crore LP in one of these funds, but the companies may not still want you as a co-investor in their cap table because you've exhausted your checks, right? You can't cut more than 2-3 crores in any single company. And the company founder, like you said, the company founder says, sorry, I'm done. I don't want you. So that's how we work. I think that's why even founders would really like us to be on the cap table, because there is a certain sense of comfort that comes in by virtue of us being an institution.
Okay, last couple of questions, Ron, before we wrap up. So, basics. How does your fund of fund work in terms of costs, expenses, carry, tenure, exits? The nitty gritty or whatever detail that you can give, and generally, how would I keep track of performance?
I think so. The fund works in a very similar way to any actual venture or private equity fund in terms of the basics, right? So there is a management fee, which is charged on a certain portion of the committed capital, and that fee is charged on an annual basis, right? Just like, so, a venture capital fund or a private equity fund, they'll have a management fee that they'll charge for the investment period, which is usually 4 or 5 years. And then after that, they charge a tapered or a lower fee with every subsequent year. And then when they generate returns, they keep a portion of those returns as carry or carried interest, right? Our fund is similar, except we have 2 legs to the vehicle. So one leg, which is the fund investment portion, there is a management fee associated with that, which is charged, on a yearly basis, and which reduces dramatically after our investment period, which is 5 years. However, we are not at this point charging any carry on the fund investment portion, which means that whatever the underlying fund returns to us as LPs, we return that to our LPs, and no leakage in the middle, right? And this, I feel, is a very strong carrot for anybody looking at a fund of funds platform, because hopefully and the way we've built out, we're quite confident that we've actually gotten access to some of the best fund managers in the country. And when we say best, we mean best in terms of performance, so your performance is likely to be a lot higher because by virtue of having these funds in the portfolio, and we don't keep any portion of that performance for ourselves. So it's a huge win for the investors. The second leg, which is the co-invest portion, again, works on a similar fashion where there is a management fee associated with finding co-invests and finding these opportunities, investing, monitoring, and exiting. However, the management fee on that is a lot lower. And there is a carry associated with the exit of those co-invests. However, the advantage again here is that we have negotiated fee-free, carry-free co-invest access from our underlying funds. So when we invest in a fund, we say, I want access to your companies and I'm not going to pay a dime for it. And the funds have agreed, which means that when we charge a carry on the exit on the co-invest portion, that's the only carry you'll pay. It's not 2 layers of carry, it's just one carry portion. And it's dramatically lower than industry standards. Industry standards are at 20%. We're in single digits. So we're really trying to encourage a lot of family offices to start investing in this platform, because the way I think about it is, it's not just one fund of funds that can change the landscape and invite or include domestic capital into this asset class. You probably need, 5 or 10. And we're starting off making it hopefully a lot easier for people to say, you know what, I get that it's a bit complex. I get that maybe I'm not directly involved, but the numbers add up. It makes sense. And maybe I'll just make one last point on this.
Please. Yeah.
The way we've done, and it's our math that we've done on the platform. Our math shows that when you invest in a fund, in a venture or a private equity fund, after all the management fees are taken over or taken out, there is a certain percentage of capital that is actually invested in companies. So if you commit 100 rupees to a venture fund or a private equity fund, maybe 85 there plus minus is actually invested in companies. That's the remaining is lost in fees.
Wow.
The way we've structured our fund of funds is that you remarkably get to a similar number in terms of actual dollars or actual rupees invested into companies. I don't mean funds, I mean companies. And that the reason why we get to a similar number is because we have a very low fee on one portion of the fund, which makes up for the double layer of fees on the other portion of the fund. So if anybody said, hey, there's an additional layer, I'm not interested in paying additional fees, you'd be surprised because you will actually end up paying the same fees, almost the same fees as you would if you were to invest in a fund. And we're really bending over backwards to kind of encourage this as an asset class in itself, because we do feel that this is the best way to institutionalize all of the capital and the best way to get involved in the growing story in India.
Yeah, in fact, that's actually going to be my last question on this episode, Ron. What is the growing story in India? As you've got a VC background, you know how this works. How do you see the startup story evolving out here? Because you've got this buzz, real crazy buzz happening on the public markets with startups now finally going mainstream, and a lot of अपना पुराना जमाने का लोग thinking यार ये कैसा loss making company का valuation हो रहा है. Just make sense of this and your view. Last question.
Now, let me, like you said, it's my view, and let me double down on the fact that this is my view. Right? This is not. I'm no pundit, of course, but I've seen this place evolve, and anecdotally speaking, like I said, I've seen it as somebody who, I've seen it from an employment perspective. Like I said, from being ridiculed to being sought after, saying, "Hey, listen, there's something going on here. We should be a part of it." And I've seen it from an investor perspective, saying, "Oh, there's no money to be made in India," to saying, "Hey, India is the place you can make the most money right now. Let's go." Right. But let's kind of take a step back and kind of see the evolution that we've come to. I think a lot of factors come into play, and of course, internet penetration and access, blah blah blah, of course exists. But that is a very important factor in the sense, even the fact that technology is such an important part of our day-to-day lives, that something like where we are now couldn't have been imagined even a decade ago, for sure. And what this means is that while distribution, again, my views, but the old world, if you will, they built their strength on the back of reaching the most number of people in the country, right? You look at some of the largest companies, FMCG companies, for example, it's all about the distribution network. They reached the smallest villages, smallest towns. They reached those individuals when nobody else could. And there was a big pay. It was very challenging for anybody else to reach those individuals. Now with technology, with everybody having a smartphone and internet on their phone, it's not that difficult to reach that audience, right? Which is what, to me at least, has been the big cause for so many startups emerging in India, because suddenly that addressable market that we always speak of is a lot more attainable than it used to be a few years ago. But what's more interesting is that when we started off, let's say from the days of Flipkart, etc., there was no Google or Facebook hiring or building out strong tech teams in India, except for back-end work. Maybe they had back offices, but for the most part, nobody was building out, let's say, product management kind of roles or any sort of direct marketing, digital marketing roles in India. These companies had to figure it out themselves. Flipkart, Snapdeal, all of these guys, they tried out Facebook, they tried out Google, they figured out what works, and they learned on the job. But now you're in a situation where you've got the alumni from all of these companies who've built a system. There's a method to the madness. They know exactly how these things work. They've branched out and started their own company. So the quality of entrepreneurship, just purely anecdotally, and also just by and it's easy to evidence it, of course, but anecdotally, the quality of entrepreneurship has gone up by leaps and bounds. So if some really smart people are betting their entire lives on this asset class, it has to mean something. And this was one of the things that I remember at Bloom, Sanjay, one of the partners, had told me. I think we were looking at investing in a company where it didn't make sense to me. Why would this business work? And Sanjay said, well, listen, the guy who's starting this is not an idiot. He knows the challenges, right? And he feels that he can build something in spite of this. And that's what we're seeing now. That we're seeing a level of entrepreneur who's seen the cycle, been in startups, seeing an opportunity and starting up. So they come with relevant experience. They come with that background, and they come with that determination. And we didn't have that 10 years ago. So if you look at all the macro factors, of course, the number of funds being raised, the number of deals happening, all of that pointing up. But if you look at the softer aspects also, the kind of people starting companies, the bets they're making on their life in terms of what they want to pursue for the next 5, 10, 7 years, it's great. And who are we to say that they're the idiots and we're not, right? I think at some point you have to join the band, right? So that's my view. I feel that we're at an inflection point. I feel that we've proven out enough, and there's tremendous potential, and it's only going to go up from now.
Yeah, I mean, there's a lot happening out there. It's obvious that the entrepreneur, the startup founder today is of a very different type as compared to what it used to be 10 years ago. So, folks, on that very positive note, on startups, on India, and a whole lot of excitement, that is a wrap on this episode of Paisa Vaisa. My guest, Rohan Paranjpey, Head Alternative Investments, Waterfield Advisors. Rohan, thank you so much. Thank you for doing this for our listeners.
My pleasure, Anupam. Thank you so much for having me here.
And folks, now the CRED privilege tip of the week. Keep a habit of maintaining your daily budget. Okay, income, expenses, savings, investment. And find an app, put it on an Excel file. I personally use an Excel file and I just love it. Just get in the habit of having a discipline around your budget. Okay, it could be a monthly budget, could be annual budget. Some people like to give a daily budget also. Like your salary comes in and you know that you're going to spend so much on this expense, so much on that expense, rent ho gaya, EMI ho gaya, this happens, that happens. And then of course, investments. Okay, so just be very methodical and disciplined about your finance, folks. That is the CRED privilege tip of the week.
And thank you, listeners, for listening to this episode. If you're enjoying this show, please do share it with your friends, family, and people that you know. That would be really helpful for us. You can listen to this show and other interesting shows on the IVM Podcast app or ivmpodcast.com. You can also follow us on our social media. We are IVM Podcast on Twitter and Instagram. And if you want to reach out to me, I'm your host, Anupam Gupta, B50 on Twitter and B_50 on Instagram. Thank you so much for listening to Paisa Vaisa, presented by CRED, the most rewarding credit card bill payments app, and powered by Quartr.
No material on the show should be considered as financial advice. The material on the show is for informational purposes only. Please consult a financial advisor before taking any investment decision.
Hi everybody, just wanted to ask everyone for a quick favor. We're running a brand survey right now and would really appreciate it if you could let us know what you think about the advertising on IVM. Go to ivmpodcast.com/survey and do let us know. As part of this, we'll be selecting 10 random participants and sending them some IVM swag, so do fill out those surveys. Hey everybody, it's been another great week on the IVM Podcast Network. On Cyrus is joined by two youth leaders from the United Nations We the Change campaign, Akhilesh Anil Kumar and Garvita Gulhati. They talk about why plastic and water are the major issues that need attention immediately. On the Wire Talks, author and journalist Pallavi Iyer tells Siddharth about her latest book, Orienting an Indian in Japan. On KBCD, we meet entrepreneur Manish Vyas, who talks to Farhad and Sunetra about the world of queer-owned businesses and the challenges they face. On Tere Mere Raste, Keshav takes us to India's biggest man-made lake, Bhopal Tal. And on Yuddha, we discuss how Akbar's fury led to creating a world-changing empire for the Mughals. Do follow us on social media. We're IVM Podcast on Twitter, Facebook, Instagram, and LinkedIn. And remember, if you're enjoying this show or any of our others for that matter, please do tell a friend. We really appreciate you spreading this. Word of mouth helps a lot. And finally, this week, we'd like to thank our sponsors, CRED, Bank of Baroda, Quartr, CoinSwitch, Kuber, Slay Coffee, and Intel. We really appreciate the support.
We live in an age of disruption, of immense change in every aspect of work, life, and business. But is the old way of doing things truly dead? And are we ever going to stop saying the new normal? Join me, Varun Dugirala, on Advertising is Dead every Tuesday as I talk to entrepreneurs, leaders, creators, and change makers from across business, media, marketing, and beyond to dig a little deeper into how we got here, what we're doing now, and where we're headed. You can catch all the episodes of Advertising is Dead on the IBM Podcast website, app, or wherever you get your podcast from.